Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 2 of Market Regulators and Frameworks, a complete beginner's guide. The FCA's authority extends beyond domestic borders, given London's status as a global financial hub. Its ability to maintain investor trust directly impacts the UK's economic standing and global competitiveness. European Securities and Markets Authority, ESMA, EU. The European Securities and Markets Authority, ESMA, is the regulatory agency responsible for overseeing the EU's financial markets. Founded in 2010, ESMA's primary goal is to strengthen investor protection and promote stable, well-functioning financial markets across Europe. But how does it manage to unify such a diverse region? Setting regulatory standards, ESMA works with individual EU countries to create consistent rules, such as the Market Abuse Regulation, MAR, and the MiFID II framework. These ensure that markets across Europe operate under similar standards. Supervisory role. While national regulators handle day-to-day oversight, ESMA supervises certain entities directly, such as credit rating agencies and trade repositories. This creates an additional layer of accountability. Reducing systemic risk. ESMA monitors cross-border risks that could destabilize Europe's economy. For example, it assesses and limits the impact of high-frequency trading and speculative activities. By harmonizing market regulations across the EU, ESMA allows for a more integrated and resilient financial system. Whether you're trading stocks in Frankfurt or bonds in Madrid, ESMA ensures the market operates fairly and transparently. From the SEC in the United States to ESMA in Europe, these regulators share a common goal: to provide stability, protect investors, and foster trust. Although their tools and methods may differ, their impact on global financial security is undeniable. Challenges facing market regulators. Regulating financial markets has never been easy, but today's challenges are tougher than ever. Rapid advancements in technology, the interconnectedness of global markets, and sophisticated strategies to bypass regulations make the task even more complex. Let's break down the most pressing issues facing market regulators today. Technological advancements. How rapid change impacts regulatory practices. Technology moves faster than regulations can keep up. From blockchain to AI-driven trading algorithms, new tools are reshaping markets in unpredictable ways. Regulators face the tough job of staying ahead while ensuring these tools don't harm investors or market stability. Automated trading risks. High-frequency trading powered by algorithms can cause massive price swings in seconds. Regulators must monitor these systems to prevent market disruptions. Cryptocurrency challenges. Cryptocurrencies operate outside traditional systems, creating gaps in oversight. Should Bitcoin be treated like currency, property, or a security? Regulators worldwide still debate this. Cybersecurity threats. Financial institutions and exchanges are prime targets for cyber attacks. Regulators must enforce strict security standards to protect markets and investors. Regulators need expertise in emerging technologies to address these challenges. But let's face it, updating policies is often slower than innovation itself. This creates a constant race to close loopholes before damage is done. Globalization of financial markets. Cross-border complications. Financial markets are global, but regulations tend to stop at national borders. This creates huge hurdles for oversight as money flows freely across countries and continents. Why is this a problem? Different rules, same money. Each country has its own laws. A transaction legal in one country might violate rules in another. Criminals exploit these differences to move money undetected. Shared problems, limited coordination. When a multinational company collapses or a major scam unfolds, it often impacts multiple countries. Regulators struggle to collaborate efficiently across jurisdictions. Tax havens. Countries with lax tax laws attract corporations and assets, often at the expense of others. Regulating these practices globally is nearly impossible without international cooperation. Think of it like a soccer game with no refs agreeing on the rules. Chaos is bound to follow. Despite organizations like the International Organization of Securities Commissions, IOSCO, encouraging cooperation, full alignment among regulators remains far off. Regulatory arbitrage, skirting the rules for profit. Regulatory arbitrage happens when businesses or investors exploit gaps or differences in rules across regions. They essentially shop for jurisdictions with more favorable regulations, sidestepping stricter standards elsewhere. What does this mean for markets? Weakened regulations. When firms choose lenient jurisdictions, stricter regulations lose their effectiveness. This undermines the integrity of markets globally. Increased risk. Companies operating in weaker regulatory environments may take on excessive risk, passing those risks onto investors or even taxpayers. Unfair competition. Businesses that follow tougher rules end up at a disadvantage. This pressures others to cut corners, creating a race to the bottom. To counter this, regulators must tighten cross-border policies and identify loopholes faster. But with firms constantly adapting to outsmart the system, this is easier said than done. By tackling these challenges head-on, market regulators can ensure financial systems remain stable, fair, and trustworthy. Yet the road ahead remains steep, and the stakes couldn't be higher. The future of market regulation. Financial markets constantly evolve and regulations must keep pace. As new technologies and global challenges emerge, regulatory frameworks face mounting demands. The future of market regulation will likely focus on greater collaboration and adaptability to address these shifting dynamics. Increased collaboration among regulators. In our interconnected world, financial markets don't stop at national borders. A transaction in one country could ripple across continents in seconds. For regulators, this means cooperation is no longer optional, it's essential. Global regulators have started sharing information and aligning strategies, but deeper partnerships are still in progress. Why does this matter? Take tax havens or cross-border money laundering, for example. Criminals exploit weak links in the system. Without collaboration, these gaps are nearly impossible to close. Imagine a unified regulatory network, where countries act less like silos and more like teammates. Organizations such as the International Organization of Securities Commissions, IOSCO, already promote global standards. As financial systems grow more connected, expect initiatives like these to expand. Key areas for collaboration include data sharing. Real-time access to cross-border financial data could help catch misconduct faster. Harmonized rules. More standardized laws would make it harder for bad actors to exploit jurisdictional differences. Joint enforcement actions. Regulators working together could prosecute violations more effectively, no matter where they occur. Think of it like a neighborhood watch on a global scale. When everyone pools resources and strengthens their defenses, the entire system benefits. Adapting to innovative financial products. Regulators face a challenge. How do you oversee products and technologies that didn't exist a decade ago? From cryptocurrency to decentralized finance, DeFi, and beyond, financial innovation is moving at breakneck speed. Traditional regulations can feel like paper maps in a GPS-driven world. Take cryptocurrencies. They blur the lines between currency, assets, and investment vehicles. Should they be taxed like stocks, treated like cash, or monitored like commodities? Governments are still wrestling with these questions, but regulators know they can't wait too long. Here's what we might see in the years ahead. Dynamic policies. Rules that adapt quickly to emerging technologies, much like software updates. Sandboxes for experimentation. Some regulators already allow companies to test innovative products in controlled settings. This approach could expand globally. Enhanced tech expertise. Agencies may need in-house experts on blockchain, AI, and other cutting-edge tools to craft effective guidelines. Is this enough? Not entirely. Innovation often outpaces rulemaking. Still, these steps could help regulators avoid playing perpetual catch-up. On the consumer side, regulation will also prioritize transparency. For example, DeFi platforms could face new disclosure requirements, ensuring users fully understand the risks. Education and clear communication might become just as important as enforcement itself. By balancing flexibility with oversight, regulators can keep markets safe without stifling innovation. After all, the goal isn't to stop progress, it's to steer it responsibly. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.